Good afternoon, everyone. Welcome to the DLP Capital Partners Impacting the Jobs Crisis Roundtable. We are excited to have everybody here. Joining us live, we have myself, Rich Delgado, Larry Hickernell on the DLP Capital side, and our CEO and founder, Don Wenner. So, Don, we're going to kick it over to you to get us started.
Thank you, Rich. Afternoon, everybody. Excited to chat here and mix up kind of our series of webinars here. We're going to focus. We focused a bit on some of the last webinars and dinners around the housing crisis that we face here in America, on the crisis of affordable workforce housing. And we're going to kind of switch gears here a bit. We'll certainly talk about our investment funds and what's going on here for those of you who are newer to us, as well as give updates for those who've been with us for years. But I want to give some insight on this jobs crisis that we face today and what's down the pike and what we're doing at DLP and how you can help contribute to impacting this jobs crisis. So a little overview of what we're going to cover on this webinar. And of course, as always, if you haven't been here before, we will be taking questions. So you can type those questions in and we will get to all questions at the end. So first, I'll give everybody a little overview about DLP. We'll touch on our investment funds really throughout. We'll talk about the jobs crisis. Some of the solutions that we're doing revolving around our elite execution system. And we'll have a little bit of polling throughout, so have your phones handy. And again, we'll open it up to questions at any point throughout. You can type into that email address there, info@dlpcapitalpartners.com, or you can call that number, and we have our investor success managers standing by as well. All right, so who we are here at DLP. We have been going through a tremendous amount of effort and energy here over this past year of really refocusing or narrowing, I guess, our focus around making sure everything we do at DLP is around making an impact. And we can proudly now say we are impact investors focused on the affordability crisis of workforce housing throughout America. We invest in providing, preserving, and creating workforce housing communities that are affordable for working families. We invest as an operator, as an equity partner, and as a lender. In addition, we manage, lease, source, sell, close, and service these investments in workforce housing communities across America. We're in 24 states today where we own communities, 30 plus states where we have loans, but with a focus on the Sun Belt region. This is the family of DLP companies that work together to execute on our investments, make an impact. The leaders here in DLP Capital Partners and our investment fund management business, myself, Bob, and Barry, are Chief Legal Counsel, Chief Financial Officer, and partners. Rich, who just kicked us off, Larry, our head of investor success, and Bo, our chief growth officer. This is the great team that makes things happen. That will be standing by to take your calls if you dial in, making sure to get distributions, reporting, communication, IRA processing, et cetera, for all of you each and every day. Our 1,600 plus investors now that we're proud to have this great team services every day. Where we operate, you're going to notice some things if you've been with us a while that are exciting and new here. Right at the center of the screen, we just last week purchased our new Florida headquarters in St. Augustine, 71,000 square foot new headquarters, as we were busting at the seams in our previous office. We still have our Pennsylvania headquarters that we've had for the last few years. And then in Asheville, North Carolina, we're actually building a regional hub in that building right there. We're going through some extensive renovations of that building. And then we have some hub offices in Florida, Pennsylvania, and North Carolina. We are a purpose-driven organization here at DLP. Our purpose is dream, live, prosper, passionately creating prosperity through real estate. We have 10 core values that drive our decisions, drive our behaviors, drive the types of people we attract to our organization. You can see those across the top and the bottom here of the screen. Statistically, this is who we are. We sold over 2,200 properties in the past year. We were just ranked a few days ago as the number 12 real estate sales team in America, number 1 in Pennsylvania and New Jersey for the 7th straight year. We currently service over 1,600 investors that we're proud to have entrusted their assets to us. We've taken that capital that's been trusted to us, and we lend it out to across over 700 loans to real estate operators, builders, developers. We own over 12,000 rental homes in our portfolio. We have over $1.5 billion in AUM. We did over $160 million in operating revenue last year alone. And we're providing today housing to more than 30,000 residents across 42 communities, serving over 200 entrepreneurs that we're lending to and helping them grow their business and create jobs and we now have over 425 team members here at DLP. Some of the highlights here from Q1. I know we're deep into Q2 already, but had a great start to the year in Q1, and we've been following that up here in Q2 and can't wait next month to share the results here from this quarter. So we're focused on making an impact here at DLP, but while not sacrificing returns. So making an impact while earning great returns. We're striving to impact 4 significant crises here in America: the affordability crisis of workforce housing, the jobs crisis that we're going to be talking about here for the next few minutes, the legacy crisis, and the happiness crisis. The definition of impact investments. People consider to be different things. I think the best definition of impact investments, what we're focused on in each of our funds, are impact investments are investments made with the intention to generate positive, measurable social and or environmental impact alongside a financial return. It's not one or the other, being able to do both. You don't have to sacrifice. It's much harder to make an impact while generating the kind of returns we generate, but it's much, much more rewarding. So we're focused on doing so through an approach of delivering consistent returns to our investors, providing, preserving, creating safe, clean, affordable housing, growing businesses and creating jobs, and helping our residents create wealth and choose prosperity. One of the largest crises in America today is the current jobs crisis and the future jobs crisis we face. COVID-19 certainly accelerated a tremendous number of issues that created a lot of shutdowns of a lot of industries, specifically caused a lot of the lower wage earners across America to suffer a significant loss in income. By some estimate, more than 13 million low-income rental households have been affected from COVID-19. We're certainly in recovery, which is exciting. In the past month of May, we had 496,000 jobs created out of the 9.3 million of reported unemployed, but nowhere near the pace that we need to see to recover from COVID-19, let alone, again, what's ahead. The U.S. added actually a total of 559,000 jobs in May, but the experts say we need more than 1 million jobs a month to get back to the pre-pandemic levels. And at this current pace, it's going to take us all the way through the rest of this year and all of 2022 to get back to pre-COVID levels. And again, that doesn't even take into account some of the disruption that's coming. Some great stats here showing some of the joblessness claims. It's unbelievable, especially, of course, as we all know, back in the March, April timeframe. Job growth, again, is picking up, which is great, but we're still short, somewhere around 7.6 million jobs. That's only the reported jobs. It's only the those in the job market today. The people who are in long-term unemployment continue to grow. Those who've been unemployed for a longer period of time, and then those who've kind of fallen out of the job market is pretty tremendous. And you see some of the different stats of why people have lost jobs and some of the statistical trends here. But it's a tremendous crisis right here, right now. Many people facing unemployment, and a lot of the additional benefits, government subsidies, are about to end. And then that doesn't, again, account for a lot of the those not even being reported because they've fallen out of the active job pool or the active employment pool. So how we're focusing on solving this crisis, first, internally, we're excited to say we've been hiring actually over 30 people a month each month this year, and continuing to pick up pace. The capital, the support, the systems, the elite execution system that we provide to other real estate operators, builders, and developers are employing at least an additional 50 jobs a month. We think it's probably closer to 100 to 200 jobs a month of those who are in our elite impact housing membership that we're helping grow their business very actively, how many jobs they're adding monthly. And through the overall elite execution system in my recent book, Building an Elite Organization, we feel we can make a much bigger impact of helping good entrepreneurial businesses be able to scale profitably, and do so consistently, creating a lot of jobs. One of the things we're doing to create more awareness for this crisis and others, and create more understanding of it, and excite and empower and motivate entrepreneurs and businesses and investors to focus in on these crises of jobs, of affordable housing, of legacy and happiness. We'll be launching in just a couple weeks a podcast called Impact. I've been recording podcast episodes with some unbelievable thought leaders and experts over the past month, and we'll be launching our first season of this show of this podcast called Impact, all focused around jobs. You see some of the episodes here, some of the first episodes that I've recorded so far, some of the great guests from professors to economists to best-selling authors to former Navy SEAL who runs a company called Talent War Group, to Eric Maddox, who's going to be one of the speakers at our upcoming event, who's an expert in negotiation and being able to get to a great solution, and in turn be able to create win-wins and grow companies. And so really been a really tremendous opportunity. And think we're going to create some great awareness. And I'll show a clip of one of those recent ones in a moment. So what's ahead here is what I'm most concerned about related to the jobs crisis that I haven't even gotten into yet. And to kind of lead into that, I'm going to ask a question here and ask you guys to participate. And I'll show you how to do that in the next slide here. So what is one job that will never be replaced? And I don't see the slide telling you guys where to enter in your proposed answer. So let me try that again. What is one job that will never be replaced by automation? So apologize. Somehow we had a Slido. It's a tech app that we use that's supposed to get you guys to participate. Not sure what the issue there was, but these are some of the common recommend or jobs that are thought to be going to be protected. Teacher being one that will not be automated. Many of these other jobs here, manufacturing, paralegals, fast food cooks, are some of the jobs that are very likely going to be automated, and we'll talk more about that. I had a privilege of doing a podcast episode here with two guests at the same time, an economist and a professor. It was pretty interesting to get some of their perspective on what I think is the big issue ahead, which is automation. That's going to replace and somewhere between 30 to 50% of jobs here in America over the next 10 to 20 years by many economists' expert opinions. So let me play this little slide here, just a few seconds, and get some perspective here from Marianne and Ofer.
The thing that will drive you to automate faster than anything else is if the price of labor is out of control, or if you think it is going to be out of control and it's going to cause you to raise your prices, you can see a way to undercut your competitor by automating a thing that they don't automate.
So what the question there, and again, we'll be sharing out this podcast in just a couple of weeks, and you can hear the whole episode. But the question there was, around this complication of automation, and it's such a complicated topic. Of people think, hey, the solution to the jobs crisis is instituting mandatory minimum wages, and Marianne was commenting that when wage costs go up, that actually causes more automation, because companies then make the determination that they can automate because the pressure and the cost of labor rise. And so it's a very complicated issue we face today, that so many jobs today are going to be replaced through technology, through computers. And some of the expected jobs that are going to be ripe for automation, things like customer service. We already have tools out there like Alexa and Google Home. Banking industry, healthcare, delivery services. The one to me that always stands out is the tellers at a grocery store or any store, and we've already been seeing it happening for years, of the self-checkout lines, but we're going to see that accelerating. There's already Amazon already has stores that don't even need to check out, so we're going to see, and there's an estimate of somewhere around 2.5 million people in cashier teller jobs in America today. Think about how many of them are still going to have jobs in that field tomorrow, or 3 years from now, or 5 years from now, 10 years from now. So it's a significant problem that's leading and impacting, will continue to impact the unemployment trends. But the good news is it's not all bad news. With automation, with innovation creates great opportunities for increase in productivity. And here in the United States, we are the home of innovation. And what drives new jobs for this new world that is being created at a rapid pace, that's been accelerated through COVID, is going to be small businesses. And small businesses are who create jobs. Governments don't create jobs. Small businesses create jobs. But it's very hard in this world today of global competition of coming out of things like COVID and the uncertainty there of all this technology innovation, to be able to grow a business, to be able to do so consistently and profitably. It's very, very difficult. But that's the key to being able to combat the automation, is we have to create new jobs that we can re-employ a lot of the labor force into. So which of these statistics about small businesses are true? Again, not sure the issue here of why the app isn't working, but the questions here are: more than 50% of small businesses fail in the very first year. 29% of businesses fail because of lack of finance. One of the top challenges small businesses face is poor quality of labor. More than 42% of small businesses fail because of a lack of market demand. Or A and C, B and C all are true. So think about that. 50% of small businesses fail every year. 29% of businesses fail because of lack of capital. One of the top challenges businesses face is labor, and more than 42% of small businesses fail because of lack of market demand. So the reality is all of these are true. It is very hard to grow a business in today's environment. And that's what the elite execution system that we run here at DLP, what the book, Building an Elite Organization, which I'm proud to announce, a couple weeks ago, we became number 4 best-selling book on the Wall Street Journal and number 5 on USA Today. We believe we can help a lot of organizations be able to scale, be able to improve their labor and workforce, hire more people, and grow and make an impact in their local community, and in some cases nationally and worldwide. And also proud to say that all the proceeds of the book go to our foundation, which is also focused on the jobs crisis. So again, the book here has some of the outline to the chapters, some of the focus around people, leadership, and being able to scale. We think of every business has 4 quadrants, which are people, operations, strategy, and acceleration, which is sales and marketing. And you have to be able to grow those at the same time together, which is hard in an entrepreneurial business with limited resources. It's very, very difficult to do. And we look to help provide a blueprint for organizations to be able to scale. We put most of our focus over the last few years of helping others do this around the world of real estate, around the world of housing, which is extra exciting because one of the best ways, if not the best way, to create jobs in America is actually through the construction of housing, which is the other big crisis. There's not enough construction of housing going on. If we can ramp up the construction of housing, that's one of the biggest drivers of jobs. So through our elite execution system and through our lending strategy, we're able to provide capital and systems to operators and builders and developers to create, improve, and preserve affordable housing while actively helping scale their businesses and create jobs. We focus on lending to borrowers who are making a difference. We're focusing on lending to borrowers who are investing in workforce housing that is affordable for the local workforce. So we're able to make a difference in both of these crises at the same time. So far this year, we've provided over 313 loans, over $265 million to our elite members. These are the real estate operators who we're partnering with, helping implement the elite execution system and helping them scale their businesses right now. So here's a little clip from one of our elite impact housing members who's growing a business much like DLP out in Texas.
We've been working extensively with DLP over the last 2 years. We've got a strong relationship now. I'm Ty Lassiter, CEO of Key City Capital, building an organization that satisfies the demand that we have now for strong jobs. We're adding jobs significantly every month. We've seen exponential growth every year. We more than tripled in size as far as employees last year. We're looking to do that again this year. And I think this goes back to the culture that we're creating. If it wasn't for our culture and a focus on building that culture first, we wouldn't be able to sustain that growth. One of them specifically is RREKs. Having clear expectations of a candidate when they come on, before they come on, and already having those conversations with that candidate and bring them along to rise up to levels probably higher than they would have otherwise expected themselves. Adding in the L10 meetings and having a structure around meetings. Oftentimes you find out in an organization that there's a lack of communication, or there's meetings where communication is had, but there's no clear transactional management coming out of that meeting. Having a structured format so that we can go in and say, here's the problems that we're having right now, here's how we're going to solve them, and here's who's responsible for what piece of that.
So those tools, you might not know exactly what he's talking about, but those are some of the tools that we help operators implement to provide structure and discipline into their organizations. Let me jump out of this.
We've been working extensively with DLP.
So we support investors like Ty and about 200 real estate operators today in growing throughout our lending strategy. The first fund that we do that through is the DLP lending fund. So we focus on not just providing them capital, but helping them scale their business, as you just heard from Ty. I'm sure we're the only lender out there taking that approach to helping our borrowers. And it's not only does it help our borrowers and make an impact on these crises, but also helps you as our investors and us here at DLP, because by us helping them put discipline into the organization, hire the right people, train them effectively, develop the appropriate communication as the organizations grow, we reduce our risk. We decrease the chance that they're going to run into financial trouble, that they're going to not have appropriate management over their projects, and we deepen our relationships with them, which has significantly decreased, defaults, delinquencies, and allowed us to help deploy more capital to the best borrowers at the same time. So some of the benefits of investing our lending fund above and beyond the impact we're making on the jobs crisis and the housing crisis is that the fund has the tax efficient benefit of being a REIT and having unlimited qualified business income deduction. You can invest in this fund via an IRA, 401k account as well. And it can be a great way to hedge against interest rate risk, because if interest rates were to go up, so would our rates, and in turn, so would our returns. The highlights of how this fund is structured, it's what we do in the fund are first position loans to real estate investors like Ty you just saw, mainly against workforce housing assets, single family and multifamily homes. This fund produces distributions every month, actually 2 distributions a month, double-digit annual returns paid out monthly with 90-day liquidity. So you can get out of the fund, which is 90-day notice. We've been running this fund now for 7 years, generated pretty incredible returns, double-digit returns year over year, month over month. And this little illustration shows you if you would have came in 7 years ago and we launched this fund and invested $250,000, you would have earned $254,761 over the last 7 years. If we had only generated an 11% return, and actually our return has been over 13% over the 7 years on average. So just gives you an illustration to the power of compounding returns, the consistent returns that we generate each and every month across all of our funds. Another fund that we run that's very similar, that's also providing capital to our elite impact housing, our best real estate operators, borrowers, is the DLP Income and Growth Fund. We're providing real estate loans and similar structure, monthly distributions, 10% preferred return, 90-day liquidity. Been running this fund now for 5 years, generated over a 12% return net to investors over that period of time, double-digit returns every single period. This just shows where those returns have been over the quarters since we launched this fund 5 years ago. Then we have another way to invest in this strategy. Instead of investing in a fund that is making loans to real estate investors, you can actually make a loan or have a note investment within our DLP Positive Note Fund, where you're actually getting a fixed return on your investment. And based on the amount of money you choose to invest and the amount of time you choose to commit, you'll get a fixed return with the option of monthly distributions or letting compounding grow up to 8%, 3 to 8%, depending on the amount of money and the amount of time you choose to commit. So that's the lending side of our house. In addition, as many of you know, we invest directly in owning real estate in partnerships with our best real estate operators, in addition to directly as the sole sponsor, operator, and developer. Here are some of the recent acquisitions we've acquired. This property is called Dream Germantown. This is actually a new construction property in the suburb of Memphis called Germantown. We purchased this property back in April. We bought a portfolio of 1,100 units in Q1 across Mississippi and Alabama, 1,086 apartments to be exact, and 4 different communities in Orange Beach, Gulfport, Jackson, and Sanatobia. In March, we acquired 2 communities from the same developer built in 2014 and 2016 in 2 towns in Kentucky. This community here in Owensboro, Kentucky, and this community here in Paducah, Kentucky, built in 2016, very similar communities. And you might look at communities like this and say, well, Don, this doesn't look like this is affordable workforce housing. It absolutely is. The average rent here, you look at this community, the newer one, $866 is our pro forma rent. The current in-place rent when we bought it was $851 a month. Had affordability of around 20%, meaning that the average amount of income of a local resident, they're only spending 20%, 1/5 of their income on rent, versus many families across America today. In fact, about half of renters today are spending over 1/3 of their income on rent, and about 1/4 are spending over half. And literally, they don't have enough money to pay for food, healthcare, basic education, et cetera. And that's our big focus around this epidemic of workforce housing. Our most recent acquisition just a few weeks ago is actually, when we acquired it, was a student housing community, and it is a student housing community. But we're going to open up this community to rent to not just students, but any resident in this market. It's near University of Mississippi in Oxford, 234 units, built in 2009. We bought this at a major distressed price from a student housing operator who was in some financial distress. Feel it's a tremendous opportunity. Looking at student asset class, a little different than most, looking at an opportunity to have great housing that we can offer to the entire market, which is a major lack of housing for non-students. Our upcoming acquisitions, we have another student housing property in Kutztown, Pennsylvania, not far from where I grew up. Actually, this is where my wife went to college. It's a 184 unit student housing community built in 2008. Also, similar situation, buying it heavily distressed. We bought it through an auction platform at about a 50% discount to what it sold for in 2013. But it's actually already now close to 100% occupied for the upcoming semester, but had some major vacancy due to COVID. But again, we're going to open up this community not just to students, but to the entire market. And then our newest acquisition that we put under contract that we're still in due diligence on is in Jonesboro, Arkansas. It's a 200-unit community built in 2000 that we're paying $81,000 a door, which is a phenomenal price for a 2,000+ unit property. Overall, in very good shape and a strong growing market, bigger than you might think. I was surprised. Jonesboro has a market of about 130,000 people, about 3 miles from Arkansas State University. And here's some of the highlights to that property. Well occupied, nice property with some good opportunities to improve the amenities, improve the performance of the community as well. So all of those assets are owned in the DLP Housing Fund. This is our fund where you can invest directly in the ownership of real estate. It's a $1 billion evergreen REIT. It was our 8th fund we launched over the past decade. Our goal is to grow this fund to providing housing to more than 250,000 residents. We're at about 15,000 today. This is where all the communities are located, heavily throughout the Sun Belt region, as you can see. This is an evergreen fund. It'll be open indefinitely. We expect to be running this fund a decade from now, 2 decades from now. Currently, we own over 6,800 units, rental homes, over $600 million. You can get out of this fund each year, and you have the option of taking monthly distributions. This fund and all of our funds provide a preferred return that's paid before we even earn our management fee. And this fund has a 12% annual return target, which we actually blew past in the first year of the fund last year. Without factoring compounding returns, we had a hair under a 14% return last year. So enough about the LP here. I'm going to talk just quickly about our upcoming events and then open it up here to questions. So coming up here, we have a big event in Asheville, North Carolina. There is still an opportunity to join us, even though we've blown past our hotel blocks, and we've already surpassed our targeted number of guests. We're going to have over 200, actually over 300 people minimum at the event. And it's going to be a heck of a turnout for some world-class speakers, which I'll show a couple of in a moment. In beautiful Asheville, North Carolina, I'm talking to you from right now, Coral Gables near Miami, or in Miami, Florida, where I got here today. I left Asheville. It was 72 and cool and beautiful this afternoon when I left. It's a great place to be in the summertime. If you've never been there, just getting to come to Asheville alone is worth the trip. But I promise that won't be the only thing you'll enjoy. There's going to be some incredible content, some great relationships built, some inspiring speakers. And we're focusing in our Prosperity, Family, Wealth, and Legacy event, we're focused on one of our other crises here, the legacy crisis, and the fact that 70% of wealthy families, and the odds are good if you're on this your webinar, you fall in that category of a wealthy family here, their fortune is lost by the second generation, increasing to about 90% by the third generation. So we're focused on helping individuals and families live and leave a legacy. It's going to be very different than probably what you'd expect at an event like this. We're not here talking about our DLP or our investments. We're here focused on you and helping you in your journey of living and leaving a legacy. So still is an opportunity to join us. You can go and we'll drop it into the chat box as well, dlpcapitalpartners.com/Asheville. Of course, just reach out to Larry, Mike, Bob, Brett, Rich, and they'll get you all set up to come join us in just a few weeks. We're going to be focusing on legacy. We're going to be focusing on family. We're going to be focusing on purpose and impact as well. We're also going to be doing at the start of this event, Thursday night, big investor dinner. We're going to be inviting a lot of local Asheville prospective investors, existing investors, as well as having a few hundred of our closest friends and investors joining us from around the country. A couple of the highlights worth coming for themselves alone. We have Hal Elrod coming as one of our keynote speakers. Hal's an awesome guy. He's going to lead us through a miracle morning, and then he'll be doing a keynote speech that evening. He is the author of a famous book sold many millions of called The Miracle Morning, which is worth learning about if you're not familiar. And if you're already familiar with it, you're going to want to meet Hal. Then we have a really cool entertainer named Oz Perlman, and he is a sought-after mentalist. Pretty cool. He's going to give an awesome entertainment for us Saturday night. So with that said, if interested, please get set up and join us. And then after that event, we've already now officially scheduled our next Prosperity event, which will be November 11th to the 14th in Ponte Vedra Beach, Florida, right near St. Augustine, where I live most of the year. And I know a number of you are located at as well. We're at the same place that we did the event this past November. But we'll be expecting an even bigger group joining us this year around. So please join us. If you can't join us in Asheville, at least get blocked off and come join us in Florida in November. But of course, we'd love to see you at both events. All right, Rich, Larry, let's start taking questions.
All right, thanks, Don. Yes, have some great questions here. And again, if you wanted to have us answer a question live, please do drop it into the chat, and we will answer as many as we can here. So our first question here comes from John. His question is, with supply prices skyrocketing, how has that affected your ability to keep projects within budget, both for yourself as well as for your borrowers?
And I apologize. So as I said, I'm in a hotel room in Miami. So my wife moved, so did the dogs. So apologize about that. So yeah, construction pricing or construction costs, not just material costs, which is what most people hear about, but labor as well, has been definitely a major challenge. What's been interesting is that every component of kind of price increases throughout the kind of supply chain is that the market is paying it. And you know, on the value side, whether we're talking home values to retail home buyers or we're talking, the value of a multifamily community, the values have actually gone up more significantly than the increase in cost of construction, which is hard to believe. I mean, we're seeing literally over 20% increase in home values and multifamily values in much of the country here over this past year. With that said, I don't expect construction costs are going to continue to stay at the levels they're at today. We're already starting to see the biggest area of increase being lumber starting to finally come back down. The issue has been supply chain and getting the material in and off of our ports. And then also the issues a lot of us are seeing out at restaurants. It's been that there hasn't been enough labor available. It's not that there's actual shortage of lumber available. It's just getting it through the supply chain. So we're already starting to see that loosening up, and we're starting to see prices coming back down. So I think we're going to have pretty significant. I'm not saying prices are going to come back to where they are, but we're going to see some good amount of deflation in a lot of the increases that we've seen so far this year. So all in all, both here at DLP and our borrowers have been very fortunate that market values have increased to a point that they've exceeded the increase in costs.
Awesome. And that's a great segue into Rachel's question, kind of talking more about the market itself. So do you see any major changes happening in valuations themselves, upward or downward? It seems like the market is overly hot pricing wise. How long do you think this will and can last? And are we close to a correction?
I wish I had a crystal ball here on this, and where it's a conversation I probably have 5 to 10 times a day with people in all different kind of experiences and all different levels. And I think the general consensus that I have, and a lot of those I talk to, as much as we're all saying we can't believe the pricing, we can't believe how expensive things are, we can't believe what things are selling for right now across the board. The kind of general sentiment that the conversations end up at, and where I often help focus people who are stressing about this, is I think the odds are greater that if we're all having this conversation 2 years from now, my guess is we're going to be much more likely to be talking about, remember back in June of 2021 when you could buy a house or an apartment community at X price, because now it's so much higher. I think we're more likely to have that conversation in 2 years than we're likely to say, do you remember in June 2021 where pricing was so crazy, and now things have come down? With that said, it's a major challenge for sure, and it's one that we're paying close attention to, and it's making it harder and harder for us to buy, because we're very much value investors, and vast majority of anything we attempt to buy, we just can't fathom the value. So that's where we end up having to find distressed, unique ways to find and unlock value, such as the couple student housing deals that I mentioned a moment ago. So we're paying close attention to it and studying it and purposely talking to a lot of people about it and trying to get our arms around the fundamentals of how so many people can come up with down payments to buy houses right now. Right, that's one of the most baffling things a lot of people are starting to understand, is how there's so many buyers for homes right now, how people come up with the down payments. It's been crazy. I've sat through and been a part of many great discussions with economists from the world of Goldman Sachs and so forth, getting their expert opinion. So it's something we're constantly talking about and looking at, but feel really confident right now that the supply and demand fundamentals are still so solid. And unfortunately for the affordability crisis, but fortunately for us as investors, rents just continue to climb at such an incredible pace, that it continues to make sense even at these prices today. Makes us a lot able to still generate solid cash flow and make sense of investments with immense rent growth.
Excellent. Thank you, Don. All right. So coming in, more questions that we've gotten here from George. You've stuck pretty closely to the markets you've been previously. Are you looking into any new markets for your portfolio to further diversify geographically?
Short answer, George, is no, not really. We're actually working to put even more focus around the markets that we believe strongest in, which are the Sun Belt region. So we're actually largely going to be in, and we always, a lot of the assets we bought in more remote locations to us, we're always short-term investments, and we're actually going to be working on exiting some of those investments that are not as core to our geographic focus. So we're most focused on the Carolinas, on Florida, on Georgia, as well as we do really like the Mississippi, Alabama, Arkansas, certain markets within that region. And of course, we're continuing to invest in Pennsylvania, as we know it really well, and very, very comfortable in the greater Lehigh Valley region as well.
Awesome. And a few more from the outside feed before we get to some of those coming in live here. We have a question from, and I love this one, from Mike. Your most recent reporting listed no delinquencies in the loan portfolio. How is that possible, and what's your secret?
Yeah, so I'd say that the starting point of how we've had such great track record in terms of delinquencies, and historically, I mean, over 7 years, we've written off not a dollar of principal or interest on any loan in 7 years, but certainly we've continued to trend downwards in terms of delinquency. It's not always going to be that way, and we'll have times where borrowers run into cash crunches and we have delinquencies. That's part of this business. We're doing short-term construction lending, where a lot of our borrowers cash can be lumpy. But the key is that we've continued to focus over these last 7 years on going upstream to the biggest and bigger and better borrowers. Our average borrower today has low 700 credit score, has $4 million net worth, has completed more than 50 real estate deals, has a lot of cash, and a lot of experience and know-how to execute. And then we come alongside of them, as we talked about earlier, and really help build deep relationships and help them execute and build deep relationships. And it's a formula that works, and fundamentals of not going, making investors or borrowers continue to have to bring significant cash to the table, keeping our leverage down. Skin in the game is still the biggest component of borrower repayment and really any form of lending. So we stay true to our fundamentals despite the incredible hot market and competition from a lot of other lenders in this marketplace.
Awesome. Thanks, Don. I have a two-part question here from Aaron. We're going to ask the first part first and then go to the second one after. So I read an interesting article recently in the Wall Street Journal about a lack of affordable housing. The 5.5 million unit deficit includes about 2 million single family homes. What are your thoughts on that?
So I didn't read that exact article, but I definitely, believe that I've heard numbers around that 5.5 million. So it's definitely somewhere in that range. In terms of the component of 2 million of single family, I don't know if there's any way to know that factually, and I don't really think residents residents who don't have a choice of rentership, I don't think they necessarily will not rent an apartment, but maybe their preference is a single family home. And I think the reality is with COVID and more people, it's declining now, of course, but still there'll be an increased amount of people working from home, where now their home is not just where they spend their evenings and their weekends, right? It's now where they work, and they need office space. And it's also been where, they've educated their children and so forth. So the need for more space and the choice of having more space and having a single family home, especially if you're going to now permanently work from home, which in the scheme of things, it's a minority of people doing that, but it's still in the millions of people. That creates more of a demand on single family rentals. And so we believe strongly in the single family rental space, and we're actively building single family rental communities today, and focused on doing a lot more of that here in the future, as we think the demand for single family rentals is only going to grow tremendously in the years ahead.
Awesome. Thanks. And that actually went on to answer a little bit. The follow-up question was, what are DLP's plans, if any, to expand our single family portfolio in building affordable single family homes? So don't know if you wanted to address any more of that, Don, or otherwise we could go ahead and move on to another question.
Cool. Yeah, I think we covered that already. So yeah, let's keep going.
Excellent. All right. Awesome. So there's a message here, a question from Carol, and this is a little bit bigger picture. So what is the one thing, if you can just have one thing that you're keeping an eye on most actively to get ahead of potential changes in the coming months and the year ahead?
I think the biggest component, the biggest thing that could make a turn in terms of home values and property values and the economy as a whole right now is interest rates. So I think that's the big concern. When you can lock in long-term interest rates today in the mid twos or high twos, it allows especially institutional investors to make sense of buying an asset at a 4 cap rate, because they can still get to leveraged returns that make sense. But if all of a sudden interest rates are 4% or 5%, that investment doesn't make sense anymore. And in turn, property values in theory and generally will decline. I think the positive is that most people, most economists and quote unquote experts do not believe the Fed is going to increase rates, and certainly not in any significant manner at any point in the near future. But if for some reason that changes and public policy moves in a direction of going through some significant interest rate growth, I think that's going to have some significant effects on the economy. So I'd say that's the biggest factor today that could change kind of the trajectory of how hot the market's been.
Awesome. So we've got a couple more coming in. First, from Kevin, he would like to know, can an investor invest in the single family rental business with DLP?
So we don't have a standalone single family rental business today that you can invest in. We certainly are working on a number of investments that ultimately would go into the housing fund that are single family rental assets. But today we don't have a specific vehicle just targeted on that. And then I'll say on the lending side of our business, a lot of what we lend on, somewhere in the neighborhood of 30 to 40% of our loans are backed by single family rentals.
Yep, great. Thank you, Don. And again, I'll just ask if anyone else has any live questions. We have one more from Ryan from the other stream, but if anyone else has any other questions, we're happy to take them before we wrap up here. But Ryan would like to, says, the Prosperity event looks amazing. Is this for existing investors only, or can someone interested in DLP but not an investor yet attend?
Yeah, great question. So if you're on this webinar, we welcome you to apply to join us, or your guests as well. So certainly the majority of those there are existing investors of ours, but we have many guests and prospective investors there as well. So certainly there is no obligation to be an investor, and there is no sales pitch on investing with us at the event. It is truly focused on family, on your wealth and your legacy.
Excellent. Thank you very much. So I'm not seeing any additional questions here. So I want to thank everyone for joining us. Hope again to see many of you in Asheville in just a few weeks. So please call us if you haven't made a reservation yet. Call us. We're happy to get you signed up, get your bookings done. And again, Don, if you wouldn't mind, wrap us up with any additional feedback.
Hey, thanks everybody. I hope you can join us in Asheville. I don't think we mentioned that on July 8th, the first night of the Asheville event, we will be streaming that virtually. So if you can't join us live, you can join us for our dinner event and zoom in to our live event in Asheville. So preference, I promise, be better to be there. But if you can't, you can at least join us virtually as well. And appreciate everybody. Appreciate your support. Hope everybody has an awesome summer, and